The starting positions surely matter going into 2025. Can you compare the starting position now into 25 versus where we were in 16 going into 17?
Yeah, I think it's really interesting because much of the policy, the rhetoric, the marginal news flow feels similar. So you can look to a 2016 playbook, but the starting point is different. So ahead of the 2016 election, we had sub 2% 10-year yields in the US. We're up at 4.5 now. We had valuations in equities that frankly looked pretty attractive back in 2016. Right now we have valuations which on any metric are expensive. So I think that's one of the big differences. So I think one of the things that is driving in these early moves post-election is a bit of a broadening out of the rally away from some of those mega caps that have the premium valuations and potentially to some of those more cyclical parts of the economy that are a little bit cheaper in terms of the stocks and potentially benefit more from the marginal news.
At the start of the show, John was talking about how the exuberance, the overpriced stocks, the valuation story was something that people were talking about 9 months ago, 6 months ago, 3 months ago, and yet we have continued to climb higher, and the fundamentals seem to be moving in the right direction. At a certain point, why would anyone left be bearish? How can somebody be left and be still solvent?
Well, I think what history tells us is that periods of exuberance can last for a long time. And the equity markets, if you look at forward returns, 3-month, 6-month returns, and you look at the correlation to valuations, there essentially isn't one. I think the issue with valuations and rates comes more when you have a catalyst. So if US growth starts to slow dramatically midway through next year, suddenly those valuations become much more of a concern. But if the economic growth is good, the earnings growth is good and potentially broadening out, then there's not really a catalyst for those valuations to come and bite.
So what do? Do you just basically dance while the music's still playing?
Well, I think one of the things you can do is look at rotation within the equity market. So I mentioned it just now that when you look at the headline PE for the S&P, it's very expensive. If you look at the equal weight S&P, which is obviously less dominated by the mega caps, it's not cheap, but it's not nearly as expensive. So this theme of broadening out of the rally is something that we've absolutely seen post-election. If you look at the flow data, you've seen massive inflows into US equity ETFs post the election. There's been more than $100 billion put to work. But if you look at where it's gone, yeah, a lot of it's gone into the broad-based ETFs, but liquidity adjusted, the biggest inflows have been into things like IWM, so the small and mid caps, RSP, equal weighted S&P, and things like the regional banks. So people are looking at things that could benefit from economic momentum, but where valuations are less stretched.
Any industries specifically you like?
So I think the cyclicals generally are the place to play that broadening out of the rally. So you can look at the industrials, you can look at the banks. I think one of the things you have to do is to look at subsectors. So we've seen some big divergence within tech where some of the mega caps haven't performed, but things like the software sector has. So I think the general theme we're looking at is a broadening out of rally out of the mega caps into some of the more cyclical parts of the economy. But clearly there are higher risks as you go further down the quality curve.